In this video, we'll look at 3 problems that deal with some basics related to revenue recognition. The first problem says on July 1st, 2021, Apache Company, a real estate developer, sold a parcel of land to a construction company for $3 million. The book value of the land on Apache's book was $1.2 million. Terms of the sale required a down payment of $150,000 and 19 annual payments of $150,000 plus interest at an appropriate interest rate due on each July 1st beginning in 2022. How much revenue will Apache recognize for the sale? Ignoring interest and assuming that it recognizes revenue at a point in time at which it transfers the land to the construction company. Here we just have sort of a theoretical consideration. It looks like in 2021, Apache transferred the land and the construction company has an obligation then to pay Apache. Apache's performance obligation has been satisfied when it transferred the land, and revenue and the related accounts receivable of the total of $3 million can be then recognized. Remember, under accrual accounting, revenue is recorded when goods and services are transferred to the customer, not necessarily when the cash changes hands in future periods. The second problem indicates that Estate Construction is constructing a building for Cyber B, an online retailing company. Under the construction agreement, if for any reason Estate can't complete construction, Cyber B would own the partially completed building and could hire another construction company to complete the job. When should Estate recognize revenue? As the building is constructed or after construction is completed? Here again, we have another sort of theoretical consideration. Remember, a performance obligation is satisfied over time if at least one of the 3 criteria are met. Criteria number 1 is that the customer consumes the benefits of the seller's work as it's performed. Number 2 is that the customer controls the asset as it's being created. And number 3 is that the seller is creating the asset that has no alternative use. If any one of these 3 are present, then we will have a situation where we can recognize revenue over time. And notice we have here that the customer is controlling the asset. It says Cyber B would own the partially completed building. So under that agreement, if for any reason Estate can't complete the construction, Cyber B would own that building and they could hire another contractor. Therefore, we have the second criteria met, and so we should be recognizing revenue as the building is being constructed over a period of time. The third problem indicates on May 1st, 2021, Varga Tech Services signed a $6,000 consulting contract with Schaefer Holdings. The contract requires Varga to provide computer technology support services whenever requested over a period of time from May 1st, 2021 to April 30th, 2022, with Schaefer paying the entire $6,000 on May 1st, 2021. How much revenue should Varga recognize in 2021? Here we have a situation where we're providing the good or service over a period of time. Thus, we cannot recognize all the revenue at this single point in time. But on May 1, 2021, we do have a journal entry to record. We receive cash. So from Varga's perspective, Varga received $6,000 and will credit deferred revenue of $6,000 as well. Remember, this deferred revenue account is a current liability account. So this is increasing a current liability when we credit it. Now, over a period of time, we'll recognize revenue, assuming that we create financial statements at the end of the year, and we'll say we have a calendar year, so this is December 31st. We'll then make an adjusting journal entry to recognize our revenue. The amount of revenue that we're going to recognize is going to be dependent upon how many months have passed. We have May through December, which provides for us 8 months out of the 12 months for revenue that's going to be recognized over that contract period. multiply that by our $6,000, which is the contract price. This indicates that we should be recognizing $4,000 worth of revenue in the 2021 period. And so our journal entry would be to debit deferred revenue, which decreases this current liability by amount $4,000, and credit our service revenue, increasing this revenue account by $4,000 as well.